why buy the 40 to 50k? Isn't better to wait for a close above the 125-day SMA or at least 44-day SMA? That's actually a good question. So should we, when we've got two models, right? We've got our moving average trend following strategy and we've got our valuation strategy of realized prices, etc. Where we've got two contradicting models. We've got the negative momentum, but we've got cheap prices. What should we actually do? Of course, the ideal scenario is that both approaches result the same, right? We are very low in our valuations and we are still above the two moving averages. Unfortunately, this doesn't happen very often. Once it does though, it does make sense to become very, very much risk on. So what I tend to do is I've got my trend following strategy. So I simply just bet on the moving average irrespective of valuations. And then I've got my part of the portfolio where I dollar cost average into Bitcoin. And that's native Bitcoin. That's not derivatives. That's not centralized exchanges. That's just native plain Bitcoin. And so what I do is basically I then have two opposing positions. I've got one position where I just bought Bitcoin and I forget about this. I've got another position where I'm shorting Bitcoin, where I'm betting on the current trend. So I will be more or less neutral during those times. Now, if we fall even further and further and things become cheaper and cheaper, I will dollar cost average in more and more with the native Bitcoin. And then I might be net delta positive. So then I might actually get more exposure, and when Bitcoin goes up, I make money. If we just start to below the cheap price, and I do think that there is still room to fall further, right? So let's say we are at 50k, and I think there's a good chance we go to 40, potentially even 30k. Then if we just started to enter the 50k mark, I'm probably still delta net negative because of the trend following. And then as we go lower and lower and lower, I dollar cost average in more and more and more until I am delta positive. And so then I'm already delta positive because we're that cheap. Then we might bottom out, hopefully at some point, and we go above the moving averages, and then I go really risk on, right? Then I'm really delta positive. I'm so delta positive from the dollar cost averaging. Now, in addition, I flip the position of the trend following, and then I'm really, really long. And that's the ideal scenario. And this works really, really well. This has worked pretty well for me in the past. I used the realized price. Just have a look at 2022. So we would start to buy in once we fall below the 20k. We would be buying in more and more and more as we fall further and further with our dollar cost averaging. But when do we actually flip? We flip once we are above the moving average. So let's go with Bitcoin again. Let's add the moving average lines. I used the 125-day at the time, or rather 120, because I've updated the back test. But yeah, I would start to buy in at around, what did we say, 20k, right? So that was here. In this area, I would start buying every now and then, even if we are below the moving average. I'll buy even further in as we are still below the moving average, but we are below the realized price. So I want to have long-term exposure with native Bitcoin. And then once we hit above the 125-day moving average, or at that time the 120, very similar though, then we go really risk on. And that's still early enough to get plenty of upside, right? So if we are below the realized price, usually we have dropped by at least 60, 70%, and then we have a multiple X return from that. And then we are fully in the market. So that's the ideal scenario. We want to ideally be below the realized price, below those cost bases, and at the same time above the momentum indicators, above the moving averages. That's the ideal scenario. This is where we should go most risk on. If we don't have both indicators flashing green, then of course we have to be a bit more balanced in our assessment. I quickly want to talk about the potential tops. So there are different approaches to measure, right? Because in the end, what we are looking at is always risk versus return. We already assessed the risk. If AI stocks are not going to crash suddenly, probably the worst case for Bitcoin is 30k. But we might already bottom out at 40k, and it might make sense to start buying in at 50k. That's at least how I personally navigate this market. The question then is always, how much could we go up from here? So what's the potential risk? Let's say we buy at 50k. What's the potential reward that we get versus that risk, right? When we buy at 50K and we could still go down to 30K and nobody's perfect, right? We don't even know if 30K will be the bottom, right? Anything could happen. But let's say we buy at 50K, we say our risk is to fall down to 30K. What is then our potential upside? What's the reward? What's the risk versus the potential reward? And that's why I like to look at the top indicators as well, even if we are currently in a bear market. There is the top cap indicator. It monotonically increases. It looks at value days destroyed. It looks at how many transactions are being made. That's currently at 647K. That's a potential top. The problem is with this indicator, it did not hit in 2021. It overestimated the top by 2x roughly. So we should at least cut this prediction in half and give this a, say, 320K top at maximum, right? So probably below that. There's another indicator which I think is a bit better. It's the delta top. The problem with this indicator is that it's not monotonically increasing. So every now and then it goes down, and that's not necessarily great. Here, our potential reward is 250K. So that's interesting, right? So we buy at 50K, we might get a 5x back in the best case. That's the delta top. Here's the terminal price, and this is the indicator I like the most. Why do I like it the most? Because during the peak in 2021, the delta top did not hit, but the terminal price did. And the terminal price is also monotonically increasing. The problem a little bit is that in prior bull markets, we tended to overshoot that terminal price, and we tend to overshoot it less and less as we went on. And so there is a chance we're actually not going to hit the terminal price this time, because we overshot more over here in 2017 than we did in 2021. And so since the overshooting, the degree of overshooting is declining with every bull market, we might not even be able to hit the terminal price this time around. What does that then mean? It means that maybe we are not going to hit that level. And so let's refresh the page. Let's look at the current terminal price as it stands. And there we go. This website is rather slow. But in general, right? In general, I like to look at price predictions that way. I like to always see what's potentially the worst case. How do I realistically look at something? So I don't just take a model as it is and then say, okay, this is our level. I try to figure out how well did it work in the past and how were the deviations from that model developing over time. So if something overshot quite a lot in the early days and then overshoots less and less over time, I think that the model is potentially overrepresenting the growth. So then it probably will underrepresent how much we could over or undershoot. So here in this case, we've got a terminal price of 300K. That would be my absolute tip-top optimal scenario. So 300K, probably take a discount from this, 250K. In the worst case, right, taking first profit at maybe 200K. We've got the 250K here as well. So 250, 250, and when we divide this by 2, 320. Probably it already starts to make sense to take first profit at 200K and then be out of the market at around 250. And as we go from 200 to 250K, we want to sell more and more. So we start buying at 50. We buy more and more as we go down to 40 and then to 30. And then we sell starting at 200K to be out of the market completely at 250K. And with being out of the market completely, I just mean with our risk on Bitcoin, right? There should always be some kind of allocation just to have a diversified portfolio. The same way we should have some allocation to gold, even if gold is now very, very high relative to the fiat currency base. We should still have 2, 3, 4% of gold in case the monetary system completely implodes. So it always makes sense to have at least some money in an asset. But we should always play around with the weightings in a diversified portfolio. And so what I'm basically saying is completely out of Bitcoin from all of our speculative BTC. Having, say, 10 or 15% of Bitcoin in terms of net worth always probably makes sense, because we can never be 100% certain. And so when we can't be 100% certain, we also shouldn't act in our portfolio in that manner that we have sold everything, or that we have 100% of everything in that asset. Of course, there are some slight adjustments to this, right? If your net worth currently is very low relative to your regular income, So let's say if you look at your monthly income and you only have, say, 2 or 3 months saved up, and that's all of your net worth, then you have to be careful, because that fundamentally means you do not need to diversify too much. You can put everything into one thing, and even if that drops by 50, 60, 70%, that's okay, because your regular cash flow, your savings can offset that drop quite a bit. But if you have several years of income saved up, say your annual income is 100K and you've got $1 million of net worth, then you have to be more diversified. Then you have to own all kinds of different things. If you then drop by 50, 60, 70%, it will take you a very long time in order to get all of that back again. So your regular cash flow could be seen just as another asset that you have, right? Your income, your job income could just be seen as another asset that you have. And the bigger that asset is relative to all your other assets, the more you are already diversified, right? Because your saving from that regular cash flow can offset all of the volatility of the rest. But if your income is not growing in the future anymore, or if it will stop in the future to a degree because you retire, or because it's relatively small relative to your net worth, to what you have in all other assets, then you just have to be diversified more. You have to be more careful, and that's how to go about diversification in general. And so that's why it's very hard to say how much should you have in each asset class at any point in time. But if your net worth is several years of your income, still it probably makes sense to have at least 5 to 10% of net worth in Bitcoin at any point in time. The same way it makes sense to have 5 to 10% of net worth in gold at any point in time. Right? So this is how it go about things. But then of course we can adjust those weightings based on where we currently see the market. And that's why we make all of this analysis. That's why we look at models like this, just to find out, are we currently cheap or expensive in a particular asset class? And since this is the Bitcoin strategy channel, I like to focus, of course, on crypto. Crypto is also the most inefficient of all of the markets, I believe. So it's easiest to time. We've got a lot of data on crypto as well. That's why I like it so much.